Imagine being able to invest in the right tech stocks with confidence and ease, based on proven methods and expert advice. Mark Mahaney's book, Nothing But Net, offers just that, a practical guide to tech stock picking that any investor can use to become more successful. Now, imagine attending the Burning Man Festival, a temporary city that emerges in the Black Rock Desert, Nevada, for just 9 days each year. While this may seem like an unlikely source of investment advice, Mahaney sees a correlation between the festival and tech excellence. In his book, Mahaney explains that Burning Man is a hub of innovation, creativity, and collaboration. People from all over the world gather to create art, music, and experiences using the latest technologies and techniques. This collaborative environment fosters new ideas and leads to groundbreaking inventions, which can translate to success in the tech industry. By studying the culture of Burning Man, Mahaney believes that investors can gain insights into the tech industry and make more informed investment decisions. For example, he explains why Amazon beat eBay in the online retail market and why short-term trading and meme stocks are not worth the investment. So, imagine taking inspiration from an unlikely source like Burning Man and using it to make smart investment decisions in the tech industry. With Mahaney's guidance, you can learn to invest in the right stocks with confidence and ease. Chapter 1. As an investor, it's crucial to prepare for setbacks. The world of stocks is unpredictable, and even the best companies can experience significant drops in their stock prices due to external factors or missteps. Therefore, it's essential to approach investing with a level head and a long-term perspective. One strategy to mitigate the risks of investing in tech stocks is to diversify your portfolio. Instead of putting all your eggs in one basket, spread your investments across various tech companies with different risk profiles. This way, you won't suffer significant losses if one of your stocks performs poorly. Another key strategy is to do your research thoroughly. Before investing in a company, read up on its financial performance, growth prospects, management team, and competitive landscape. Look for potential red flags, such as high debt levels, weak earnings, or legal troubles. Lastly, it's vital to have a plan and stick to it. Determine your investment goals and risk tolerance, and create a portfolio that aligns with them. Don't let short-term market fluctuations or hype dictate your investment decisions. Instead, focus on the long term and be patient. In summary, while investing in high-quality tech stocks can be lucrative, there are no guarantees in the stock market. It's essential to prepare for setbacks by diversifying your portfolio, conducting thorough research, and having a plan. By following these strategies, you can improve your chances of success as an investor. Chapter 2. As Mahaney suggests, focusing on the long-term fundamentals of a company is the key to successful investing. This means looking at the company's business model, financials, competitive advantages, and growth potential over a period of years, rather than just a few months or quarters. One important factor to consider is a company's competitive moat, or the extent to which it has a sustainable competitive advantage that will allow it to maintain its market position over the long term. This could be in the form of patents, network effects, economies of scale, or other factors that make it difficult for competitors to replicate the company's success. Another important consideration is the quality of a company's management team. A competent and experienced management team can make all the difference in the success or failure of a company, so it's important to look for companies with strong leaders who have a track record of delivering results. Finally, it's important to be patient and disciplined when investing for the long term. This means avoiding the temptation to buy and sell based on short-term market fluctuations, and instead focusing on buying high-quality companies at reasonable prices and holding them for the long term. By following these strategies, investors can improve their chances of success and achieve their long-term financial goals. Chapter 3. One of the most important things for investors to consider when evaluating tech stocks is revenue growth. Consistent revenue growth of at least 20% over 5 to 6 consecutive quarters is a good indicator of a high-quality, high-growth company that is likely to perform well in the future. Companies that successfully implement growth curve initiatives, GCIs, such as new product launches or geographic expansion, can also be good investments. However, revenue growth alone is not enough to determine the quality of a company. According to Mahaney, There are 4 key drivers of high quality that investors should also consider. 1. Market size. The larger the potential market for a company's product or service, the greater its growth potential. 2. Competitive advantage. Companies with a competitive advantage, such as proprietary technology or a strong brand, are more likely to maintain and increase market share over time. 3. Management. A strong management team that has a track record of success is essential for executing on growth strategies and maximizing shareholder value. 4. Financials. Companies with a healthy balance sheet, low debt levels, and consistent profitability are more likely to withstand economic downturns and continue to grow over the long term. By considering these 4 drivers along with revenue growth and GCIs, investors can identify high-quality tech companies with strong growth potential that are likely to perform well over the long term. Chapter 4. Product innovation and total addressable market are 2 key drivers of revenue growth that tech investors should consider when picking stocks. Product innovation refers to a company's ability to develop new and improved products that can generate new revenue streams and enhance existing ones. It is something that can be easily observed by consumers and can lead to repeatable offenses. For example, Apple's annual release of a new iPhone or Amazon's launch of the Kindle are examples of successful product innovations that have benefited these companies. Total addressable market, TAM, is the second key driver of revenue growth. It refers to the total size of the market that a company can potentially serve with its products or services. A larger TAM means greater opportunity for premium revenue growth and an increase in scale, which can lead to competitive advantages over rivals. For instance, Netflix started as a DVD rental service, then introduced streaming as an innovative product, which expanded its TAM. Its international presence also increased its TAM, making it a good sign for investors. In summary, product innovation and TAM are 2 factors that investors should consider when selecting tech stocks. Companies that can consistently innovate and have a large TAM tend to be more successful and generate higher revenue growth. Chapter 5. Understanding the factors that drive revenue growth is crucial when investing in tech stocks. In addition to product innovation and total addressable market, 2 other important factors to consider are customer centricity and good management. Customer centricity means putting customers first, and companies that adopt this approach tend to be more successful in the long run. A good example is Amazon, which launched Prime in 2005 and was willing to sacrifice short-term profits to benefit customers. This strategy paid off, and Amazon became the undisputed king of online retail. Good management is also critical for the success of a tech company. Look for founder-led companies with management teams that have a good tech background, a successful track record, and an obsession with customer satisfaction. Companies like Amazon, Google, Apple, Facebook, and Tesla, which have had CEOs attend Burning Man, have also had strong leadership and have performed well in the stock market. Remember that investing in tech stocks can be risky, and it's important to do your research and consider all the factors that drive revenue growth before making any investment decisions. Chapter 6. Investing in stocks requires a certain degree of confidence and understanding of key drivers of revenue growth. While valuation frameworks can be useful to some extent, it's important to recognize that investing in stocks is not a science and there will always be some level of uncertainty. COVID-19 and Uber's recent performance are examples of how unforeseeable events can drastically impact valuations. Therefore, it's important to approach valuations logically rather than relying solely on mathematical calculations. When considering valuations, investors should focus on assessing the company's earnings and whether the growth is sustainable. For companies with minimal earnings, investors should consider evidence of future potential, such as major investments that could drive profitability. Even companies with high price-to-earnings multiples can turn out to be good investments, as seen with Amazon and Netflix. When evaluating unprofitable companies, investors can apply logic-based tests such as assessing the profitability of other companies with similar business models or considering the company's overall potential for profitability based on present knowledge. By applying logic-based tests, investors can make informed decisions and increase the likelihood of choosing the right stocks. Chapter 7. Investing in stocks, particularly in the tech industry, can be exciting and potentially profitable. However, it's important to approach investing with caution and a clear strategy. One key point to keep in mind is to avoid investing in fads. This means avoiding stocks that are only popular because of hype or a current trend. Instead, focus on companies with solid fundamentals and strong growth potential. Another important factor to consider is to conduct thorough research before investing. This involves assessing the company's financials, management team, and growth prospects. Doing your homework will help you make informed investment decisions and avoid costly mistakes. It's also important to stay humble and acknowledge that even the most experienced investors can make mistakes. Rather than trying to beat the market with risky investments or day trading, it's generally better to invest in high-quality companies for the long term. Finally, investing in tech can be rewarding in more ways than just financial gain. The industry is constantly evolving and has the potential to create innovative solutions to some of the world's most pressing problems. By investing in tech, you have the opportunity to be a part of this exciting progress. Summary: investing in tech stocks can be a lucrative opportunity for investors, but it's important to approach it with caution and diligence. It's crucial to avoid falling for fads and meme stocks and to focus on high-quality companies with strong fundamentals and growth potential. Doing your research and assessing the company's criteria can help you make informed investment decisions. It's also important to have a long-term perspective and be prepared for possible bumps in the road. Ultimately, investing in tech can be rewarding not just financially, but also in terms of the satisfaction of watching the growth of the tech industry. Now, thank you for taking the time to watch, and if you found value in this video, be sure to hit that like button and subscribe to my channel for more great content. Trust me, you won't regret it.